I published my weekly blog last Wednesday. As discussed there, I have shifted back into a net seller of common stocks and stock funds. And that shift out of stocks has accelerated since I published that post based in part on my conviction that Trump was going to start a trade war. My treasury bill and investment grade corporate bond purchases are remaining relatively constant. I had 48 corporate bonds mature today, and I will be redeploying the proceeds from those maturities into primarily treasury bills. I will be participating in the 6-month and 3-month treasury bill auctions on Monday. As Trump has threatened to do, and with no good reason whatsoever, Trump has imposed a 25% tariff tax on all U.S. imports from Canada and Mexico except for Canadian energy products that will be subject to a 10% U.S. tariff tax. Imports from China will be subject to a U.S. 10% tariff tax. The tariff taxes are paid by U.S. importers, and then all or almost all are passed on to U.S. consumers, thereby contributing to inflationary pressures. About 1/3 of Canadian exports to the U.S. are energy products. Canada is the largest importer of U.S. products. Energy products account for all of the U.S. trade deficit with Canada. Without energy imports from Canada, the U.S. would have had a trade surplus with Canada in 2023. I will cite the source for those statements in the more section below. In Trump world, where just about everything that is false becomes true through repetition, constant repetition, the tariff tax is paid by the foreign country, and the tariff tax is like free money to the U.S. government and will not harm U.S. consumers or exporters in any way. I discussed that false assertion that's constantly made by Trump in several YouTube videos, and we'll link one in the more section below. Perhaps the U.S. importer of products from Canada or Mexico can refuse to pay the tariff tax, pointing out what Trump has repeatedly said, that the foreign country has to pay the tariff tax for those imports to the U.S. Just send the bill to to Canada's government or Mexico's government. They could tell the customs agents, relying on what Trump has said in the past. Starting a trade war with the lessons from the Smoot-Hawley Tariff Act passed by the Republicans and signed into law by Herbert Hoover in June of 1930 being long forgotten, makes me less willing to assume common stock risk. Tariffs will be inflationary, and inflation has already proven to be sticky near current levels without other factors starting to increase inflationary pressures such as tariffs. Most of my investments now are in treasury bills and treasury notes, investment grade corporate bonds maturing in less than 3 years, some CDs, treasury money market funds, preferred stocks, primarily Canadian reset equity preferred stocks, and about 10% weighting in common stocks that pay dividends. I will invest in speculative non-dividend paying stocks as an alternative to playing blackjack at a casino. Even when taking some risk, I use a variety of risk mitigation strategies to reduce the relatively small risk that I am taking in stocks and what is already a conservative, extremely conservative portfolio. When I'm comfortably earning annual income after taxes to pay my living expenses and then to reinvest about 30 to 50% of what is left after those expenses and taxes paid, moving toward the lower end of that 30 to 50% range when I have a major one-time expense like putting on a new roof, which I installed last year. And that's where I'm at now. My willingness to assume stock risk will go down, and I have reduced my stock allocation in 2023 and more in 2024 as safer investments have generated more income as interest rates started to rise in 2022. What I'm doing is fine for me given my age, financial condition, and owning everything debt-free. Given those factors, my willingness to assume stock risk is made even less likely based on my opinion that stocks are or will likely become more risky than normal, defined simply as non-temporary declines in value due to a variety of factors, including excessive optimism about future earnings, which is common now among stocks that have led the market higher, elevated valuations using traditional criteria, all of which are well above historical averages, like the index PE ratios, using trailing 12-month GAAP earnings, the Buffett indicator, which is the market cap to total stock market capitalization ratio, which is significantly higher now than the all-time high hit in 2000, the Shiller PE ratio, and the dividend yield of the S&P 500, which is now almost identical to the all-time low hit in 2000. These valuation kinds of charts can be found at several websites, including one that I previously mentioned called Long-Term Trends. Just Google that phrase, run it all together, long-term trends, and you will find it. Stock valuations can remain well above historical norms for an extended period using the standard valuation criteria that I just outlined. So simply being much higher than an historical average is not a short-term trading signal. There generally needs to be one or more catalysts that causes a herd-like flight and a reversion back to more reasonable valuation ranges. I discussed some of those possible catalysts in a recent YouTube video, which includes a tariff war being started by Trump, which I will link in the more section below. Investors have shrugged off the negative impacts from a trade war so far, at least through last Friday, maybe due to a belief that Trump is all bark and no bite when he threatens other countries with tariffs, or that even if he followed through with tariff increases, they would result in the matters being quickly settled by the countries, the involved countries. Valuation resets can be very painful for stock investors. What happened in 2000 to 2002 is an example of a mean reversion, with the S&P 500 falling about 50% to return to what I consider to be something resembling a fair value range after that decline. Researchers use different charts and different starting points and end points for that decline. Yardeni, who has a lot of charts that are worth looking at, starts the decline I have it written here, March 4th, 2000, with the S&P 500 close at 1527.46 and ends the decline at 776.76 on October 9th, 2002, or a 49.1% decline from top to bottom. The S&P closed at 6,040 last Friday, which is a 638% rise in less than 13 years from that low of 776.76 hit on October 9th, 2002. No one can predict the future, but an assessment of the downside risk and probabilities that those risks will have a significant impact on the stock market can be based on historical reversion to the mean information and other important factors impacting the economy like GDP, employment and wage growth, and the future course of inflation and interest rates. Inflation is, in my opinion, the most important long-term secular force that can cause major adjustments to my investments. My memory is just seared with what happened in the 1960s and 1970s and the effect that problematic inflation and high interest rates had on both the bond and stock market failing during that period. I arrived at the conclusion that inflation is the most important long-term factor, as I said early in my when I started to invest, because that was occurring during a long-term bear market in stocks and bonds. Starting around January 1st, 1966 through July 1982, the average annual total return of the S&P 500s, and that would be with dividends reinvested and adjusted for the high inflation numbers during that period, was a negative 1.83%. That is negative 1.83% per year. The after-tax real total return would have been worse. So emerging inflation needs to be addressed quickly by the Federal Reserve, which it completely failed to do in 2021, and did exactly what it should not do: keep expansionary monetary policies known as ZIRP and PE in effect throughout 2021 until the annual CPI rate hit 8.5% in March 2022. A fair question to ask now is, how will the Federal Reserve respond when inflation starts to move higher, unemployment increases, and real GDP growth stalls and starts to move back down? The bond ghouls are probably thinking, as shown in the rise in intermediate and longer-term interest rates starting in mid-September when the Fed cut the federal funds rate by 50 basis points, that the Fed will allow inflation to go higher rather than raise interest rates when inflation is moving higher, and will again stimulate the economy with its toolbox of extremely abnormal monetary policies. And that may explain why intermediate and longer term interest rates have been trending higher since mid-September of 2024. I received today about $48,000 in proceeds from investment-grade corporate bonds in 3 accounts that I have. I will be buying my first disbursement, I should say, of that amount will be $15,000 in the 6-month Treasury bill auction and $5,000 in the 3-month Treasury bill auction on Monday, and most of the remainder will be redirected into more purchases of investment-grade corporate bonds maturing in the 2026 to 2028 time frame as I continue to fill gaps in my bond ladder. I will probably not be buying hardly any stocks until I can assess the fallout from the ongoing trade war.